In this topic, we'll zoom out and look at who actually makes RWAs work and how each player gets paid. You'll see how issuers, DeFi protocols, and service providers connect physical assets to on-chain liquidity, and where both value and risk concentrate along that chain. Think of the RWA pipeline as a bridge from messy real-world assets into clean on-chain positions. First, assets are sourced and underwritten. Who's borrowing, what backs it, and how it's expected to perform. Next, lawyers package those assets into legal vehicles that can promise specific cash flows. Then tokenization mints an on-chain claim that maps to those rights. Finally, tokens are distributed to investors, and cash flows are serviced and settled back into crypto. Issuance and aggregation platforms are that bridge in practice. They source things like invoices, mortgages, or credit deals, and do the heavy lifting, underwriting risk, structuring a legal SPV or fund, and wiring that into permissioned smart contracts and off-chain systems. What investors finally see is a neat ERC20 or NFT representing fractional ownership. These platforms earn setup fees, ongoing servicing fees, and a slice of the yield spread. MakerDAO is a clear example of RWAs plugged into a crypto-native system. On one side, there are on-chain RWA vaults and governance. On the other, professional asset managers run the off-chain portfolios. Those portfolios are mostly T-bills and high-grade credit. Their yield flows into Maker's surplus buffer, which then funds the DAI savings rate and MKR buybacks and burns. So RWA yield directly supports both DA stability and MKR value. Ondo shows how Treasury RWAs work operationally. User dollars or stablecoins flow into a regulated offshore fund, which buys real-world US Treasuries. Legally, investors own fund shares. On-chain, they hold ERC20 tokens that mirror those shares and plug into DeFi rails. Yield comes from Treasury returns, minus management fees and spreads, with additional upside from protocol incentives. Maple illustrates how private credit becomes an on-chain product without turning lenders into credit analysts. Institutional borrowers receive under-collateralized loans off-chain. Professional delegates sit in the middle. They underwrite borrowers, structure the legal entities, and decide how pool capital is allocated. Liquidity providers simply supply capital to the pools and can stake for downside protection. Fees flow to both the protocol and the delegates in exchange for sourcing, monitoring, and managing that real-world credit risk. Centrifuge demonstrates how DeFi rails connect to messy real-world credit. Originators bring invoices and trade finance deals. Each asset becomes an NFT, then is sliced into ERC20 tranche tokens. Senior investors get paid first with lower yield, while junior investors take first loss but earn more. Behind the scenes, an SPV legally owns the assets, and the protocol captures value through setup and servicing fees. These four protocols showcase very different RWA playbooks. Maker leans safest, funneling T-bill yield to the DAO via bankruptcy remote trusts. Ondo wraps off-chain funds into tokenized shares and charges classic asset management fees. Maple targets corporate credit, with delegates running lending SPVs and earning origination fees. Centrifuge goes deep into trade finance, using SPVs and tranching to slice risk and monetize protocol volume. When you hear RWA in DeFi, focus on who actually wants this collateral. There are three main demand lanes. Lending markets use tokenized T-bills as rock-solid collateral to attract safer borrowers. Stablecoin issuers hold similar assets as reserves to defend their peg. And yield aggregators route deposits into curated RWA vaults, hiding most of the underlying complexity. Stablecoin reserves have quietly evolved from pure black boxes into something closer to on-chain treasuries. In the classic model, issuers hold T-bills and bank deposits off-chain. You get stability. They keep almost all the yield. In the emerging RWA model, that same T-bill exposure is tokenized. Part of the yield can be streamed to DeFi users, while protocols monetize with spreads or fees. The collateral hasn't changed, but the value distribution has. Off-chain service providers are essentially the ops team that makes your RWA yield real, not just numbers on a dashboard. Custodians and trustees act like multi-sigs and cold storage in the real world, actually holding assets and routing cash. Kitesy and onboarding replicate permissioned whitelists, deciding who's allowed into a pool. Legal structuring firms play the role of protocol architects and auditors, translating economic design into enforceable contracts regulators will accept. Real-world assets only work if on-chain logic can respond to off-chain reality. First, data is captured. Performance, NAV, defaults, prepayments, everything a credit desk cares about. Then Oracle networks securely push that state on-chain, with guarantees around uptime and tamper resistance. Finally, smart contracts consume those feeds to automate actions like liquidations, interest rate changes, and collateral factor tweaks. If any link in that chain is weak, your RWA yield becomes a black box you can't truly underwrite. You can think of RWA designs on two axes: DeFi composability and regulatory friction. More on-chain, permissionless designs plug cleanly into DeFi, but take on higher legal and enforcement risk. Add off-chain controls, SPVs, and KYC, and you gain enforceability and investor protections, but lose some open access and automation. As an investor or builder, your job is to choose the mix that fits your goals and risk tolerance. RWA yield works like a waterfall. At the top is the gross asset yield, what the real-world asset actually earns. From that, originators take a cut for finding and structuring deals. Next, servicers and infrastructure providers get paid to custody assets and keep the legal machinery running. Then the protocol charges its own fees or spread. Whatever remains after all those layers is your net investor yield. If yields look too high, always ask who's getting paid where. The RWA protocols that endure won't just tokenize assets. They'll become core DeFi collateral. Think T-bills and credit indices plugged into money markets, stablecoins, and yield strategies. They'll combine clean, auditable legal rights with sustainable yields driven by real-world spreads, not emissions. Aim your skills and capital at that intersection.